In the fall of 1988, the board of one of America's largest companies sat down to pick a winner. On the table were two offers for RJR Nabisco. One was worth $112 a share. The other was worth $109. The board took the lower one. That decision closed the largest leveraged buyout in history. About $25 billion in equity, more than $30 billion once you count the debt the buyers piled on. It made the firm Kohlberg Kravis Roberts the most feared name on Wall Street. And here is the part almost nobody remembers. The deal that defined an era of deal-making went on to earn the people who won it almost nothing. RJR Nabisco was built in 1985 when the tobacco company R.J. Reynolds merged with the food company Nabisco Brands. The logic was diversification. Pair the enormous cash flow of cigarette brands like Winston and Camel with grocery aisle staples like Oreos and Ritz crackers, and lean away from a tobacco business facing lawsuits and regulation. The company made money. What it could not do was lift its own stock. Through 1988, the shares sat around $55, going nowhere, weighed down by tobacco litigation fears and a string of product flops, including a smokeless cigarette that drew more ridicule than revenue. Running the company was F. Ross Johnson, a Canadian executive known less for strategy than for spending. A fleet of corporate jets insiders nicknamed the RJR Air Force, country club memberships, athletes on retainer. Johnson had tried everything to move the stock, and nothing worked. So he reached for the tool that defined the decade, the leveraged buyout, where a buyer uses mostly borrowed money to take a company private, then uses the company's own cash flow to pay the debt back. RJR was a textbook target: steady cash, valuable brands that could be sold off, and very little existing debt to get in the way. On October 20th, 1988, Johnson went to his own board with a proposal to buy the company he ran. The offer was $75 a share, valuing RJR Nabisco at roughly $17 billion, backed by the brokerage Shearson Lehman Hutton. On paper, it looked generous, about a third above where the stock had been trading. But Johnson had a problem, and it was in the fine print. He and 7 other executives had negotiated what Barbarians at the Gate, the definitive account by Wall Street Journal reporters Brian Burrow and John Hellier, called history's richest management agreement. The 8 men would put in about $20 million of their own money for an initial stake of 8.5%, structured to grow toward roughly 18%. When analysts modeled it out, that slice could be worth on the order of $2.5 billion within 5 years. Johnson's own exit package, if he left, was valued at around $53 million. The board did not say yes. Instead, citing its duty to shareholders, it set up a special committee of 5 independent directors, chaired by Charles Hugel, and opened the company to other buyers. Johnson had wanted a quiet insider deal. He had started an auction. It did not take long for the most aggressive firm on Wall Street to show up. Kohlberg Kravis Roberts, KKR, was run by the cousins Henry Kravis and George Roberts, and they were the pioneers of the giant leveraged buyout. In late October, KKR came over the top with a tender offer at $90 a share, roughly $20 billion, structured so it did not need management's cooperation to proceed. That move turned a boardroom courtesy into a public war. Over 5 weeks, nearly every major firm on the street circled the company: Forstman Little, Solomon Brothers, Goldman Sachs, Merrill Lynch, First Boston. KKR and Johnson's group briefly tried to join forces. The truce collapsed within a day. First Boston jumped in with a complex tax deferral structure that, on paper, ran as high as the mid-20 billions and forced the committee to reopen the bidding. KKR leaned on the firm that powered the debt machine, Drexel Burnham Lambert, along with Merrill Lynch, to raise billions in high-yield bonds, what the market called junk. By the final week, the price for a company that had traded at $55 had nearly doubled. On the night of November 30th, 1988, the special committee took its final bids. Johnson's management group offered $112 a share, about $25.4 billion. KKR offered $109, about $25 billion. The higher number lost. There were two reasons. The first was structure. A large part of each bid was not cash but securities, and the value of those securities depended on a feature called a reset, a promise to adjust the interest rate later so the bonds would trade at full value. KKR's package was judged more certain to actually be worth what it claimed. Management's, the committee concluded, might quietly be worth less than the $112 on the label. The second reason was Ross Johnson. The size of his management agreement had become a public scandal. That December, Time magazine put him on its cover under the words, "A game of greed," noting he could personally pocket around $100 million. 5 days before the decision, Johnson told Time, "They are not going to approve our bid." He was right. The board handed RJR Nabisco to KKR. Johnson left in early 1989 with a golden parachute, valued at about $53 million. KKR brought in Louis Gerstner, who would later be credited with turning around IBM, to run what it had bought. KKR had won the biggest prize in the history of deal-making. Then the math arrived. The company now carried roughly $25 billion of debt, about 5 times what it owed before. Much of that debt sat in bonds with that reset feature. And as the business struggled, honoring the reset would have meant pushing interest rates toward levels that would have guaranteed bankruptcy. In 1990, barely a year in, KKR was forced to pour in about $1.7 billion of fresh equity and arrange roughly $2.25 billion in new loans just to keep the company alive. The buyout's existing bondholders, meanwhile, had watched their bonds lose value the moment the debt was loaded on. One of them, Metropolitan Life, sued. The court sided with the company, ruling that lenders who wanted protection from a leveraged buyout had to write it into their contracts, not assume it. That ruling gave the bond market a permanent new vocabulary word: event risk. So who actually won? The selling shareholders did. Their $55 stock got cashed out around $109. The bankers and lawyers did, splitting fees that ran past $1 billion. But the company was carved up to service its debt. The original bondholders were burned. And KKR, the firm that beat everyone, earned its investors a return of well under 1% on the largest buyout it had ever done. Henry Kravis himself later admitted the firm had put too much of its fund into the deal. RJR Nabisco didn't end the leveraged buyout, but it set the high watermark for how much debt, ego, and certainty a deal could carry, and then showed, in slow motion, exactly what happens when the cash flow can't keep up. The biggest deal in history is remembered as the one almost nobody won. Thanks for watching. See you in the next one.